and wrap up the season, which ultimately gives a slight sense of opportunity for year in review of flexion. And I think in some ways the major three trends of 2022 have kind of culminated all together in the sort of front headlines of the last week, and so timely not only to think about them in the week in review, but also in the year in review. And those three dominant trends of the year seem to me: China COVID, lockdown, and now reopen; the Fed tightening and slash inflation battle; and the third, of course, the Russian war in Ukraine and the sanctions and the now price cap EU embargo on oil, marine oil out of Russia. So those three are the big themes of the year, and I think of current. And I want to touch on all three this morning with Brent trading a little bit down today at 82.14, but broken and above the $80 barrel and holding. Let's kick off with the sort of biggest headline, I suppose, overnight, and that's obviously for the year in itself. Fed tightening, the Fed announcing its seventh rate hike of the year, 50 basis points, and the scale and significance of that. The market seemed to be already having a party that peak everything had been achieved, and so now it was sort of whatever they do is irrelevant. Christophe Roule, Senior Research Scholar, Center on Global Energy Policy at Columbia University. Christophe, your thoughts of the news overnight, the Fed decision? It seemed to be a bit more bullish than the market was anticipating. Is that us done now with all tightening? Your thoughts?
Not quite done, but you have to draw your head off them, take your head off, because so far the operation was enormously successful. Was where signals happened with a minimum set of disruptions from an extremely low starting point, into sizable things. And they continue to claim that they want to hit the 2% inflation target, which is the same as to say that the rate rises will continue, just not at this pace of 0.75% every time they meet. But I think overall the likelihood of a soft landing, as they call it, has increased. And what's to me the most amazing thing in the US is the strength of the US economy, the strength of the labor market in the face of all of this. Longer term, because you said trends, the tightening cycle might come to an end, but whether inflation goes back to 2% or below, to me, is a different matter. And the reason is the same in the US as in Europe and in other advanced economies. It's this enormous debt burden. And the US is building up just also over 22 an enormous, massive increase in government debt. In one way or another, this has to be repaid. And a persistent, if low, inflation tax translating into 3%, 3.5% maybe of inflation, supporting higher nominal GDP growth to inflate the debt, to deflate the debt GDP ratio. That seems to be the most likely outcome of the current shorter-term tightening cycle. But for markets, that's probably good news, and it probably means that we can continue in the US and elsewhere to live in an area of increased government expenditures for emergencies and also for big climate-related, energy-related investments with a higher inflation rate than we had in the past. So a different situation from the more market mantra of the early 80s, and a secular shift.
Mike Muller, head of Vitol in Asia. Mike, your thoughts on this sort of, obviously the recent decision, the price of money now is more expensive than it was yesterday. What does it mean for the markets? We've seen that the markets were getting, the oil markets in particular, getting some kind of lift from a weaker dollar, a peaking of rates. And so with that, an upswing in the front month. Your thoughts?
Two things come to mind, Sean. I mean, one is we clearly have a cost of living crisis, which is causing abstention from consuming in those strata of society that can't afford things like the escalated cost in heating bills in Europe, for example. So that's hitting things on the demand side. And on the more corporate side of things, I mean, the demand for more substantive dividends from large listed companies is now a given, I guess, because they need to make their stocks attractive to investors at a time where the demand side is possibly shrinking. And the other problem for those corporates is that we were hoping to see a large surge in reinvestment because we still have a large cycle of underinvestment in the energy sector. And that's made all the more challenging by the higher cost of capital as well, because you need to make the same sort of IRR on a project. You need to factor in a higher cost of borrowing if you're leveraging your project by getting bank finance. So all those things are different to what was the case 2 years ago.
And Christoph, in that sense, we're sort of talking about the trend of the year, a lot of tightening, a very aggressive Fed rates, and also other OECD markets, and we're seeing there to present today the UK and the EU. But the volatility that came with that sort of uncertainty and inflation noises, will that now help the markets calm down a bit, do you think? The fact that we're sort of seeing the end, or a predictable end, to this interjection from policymakers?
Yeah, and you have to keep in mind that one of the reasons that markets basically took all this pretty much in their stride, as much as could be expected, is that real rates are still negative. You know, we are far from a situation of severe financial austerity or anything like that. They will remain negative for some time to come. And then inflation hits everyone, hits consumers, as Mike has said, hits also producers. The interesting thing, what it does usually, it affects creditors in a positive way. So if you borrow money and you have to pay back less in real terms, and that is usually the kind of sectors in the economy which expand and which invest and which are therefore in debt. So they benefit from that situation if it continues longer. That's not necessarily the energy companies, which have very low gearing ratios and which, in particular in the US, are busy doling out dividends rather than borrowing more money. So they indeed will have to come up with other incentives, like continue their high dividend payments. But overall, I think as uncertainty subsides and as the inflation outlook becomes more sanguine, I think, of course, markets will continue to calm down. And we should just never forget, no matter what we talk about when we talk about energy, that volatility should not be a bad word. You know? Prices have to jump around, and in very difficult times such as now, they have to jump around a lot in order to get resources where they are needed. You saw that in Europe. You know, it took a very, very volatile gas market, but eventually you had enough energy shipments to line up and for the gas stations not to be sufficient to take care of all of them. That's the kind of market reaction one wants to see, actually. And so this volatility is driven more by underlying developments in connection with Ukraine, in connection with lack of investment, than by inflation rates.
Mike, the tail of this rate cycle is from a demand destruction point of view may still yet to become with the follow through on mortgage payments and all the burden of higher costs of money, and so the impact for demand may still be yet to play out on this tightening cycle. Your thoughts of how that carries through to the new year?
Well, we've seen the volatility most graphically, I think, in natural gas, where in Europe there was, as Christoph alluded to, there was a rapid deployment of regasification facilities to alleviate the bottlenecks and perceived supply shortfalls into the places that really need it, like Germany. And credit to Germany for putting a regas in by the end of this year. After all, I think we had a discussion 5-6 months ago where one of you two gentlemen volunteered that you would eat something inedible if that were to be the case, but Germany mobilized quickly there. But natural gas prices, LNG prices, and the cost of LNG carrier ships all came off on a perception that Europe is now going to get by and not have to have quite the levels of austerity that winter weather was going to impose. That said, we've had cold snaps, not just in Europe, which many observers are probably aware of, snow across many parts of Europe, but also in key population centers in Northeast Asia. And that's given the LNG market pause for thought, because it does remember what happened in 2021 and also in 2020 with the aging liquefaction infrastructure, and the price impact of just one major train going down in the LNG world could very quickly reset this market into very, very, very concerning levels. And indeed, gas prices have moved up on the weather alone, along with those concerns. And bear in mind also, of course, that we've come off the back of some major concerns over nuclear generating capacity in places like France, and of course, a longer term situation in Japan also, where that capacity is not entirely back yet. So that has definitely eaten into demand. I saw a statistic recently that 1 in 4 households in the UK have to pay before they consume their domestic natural gas. So that's how the utility companies make sure they don't have too much bad debt on their books. Reminds me of my younger days when you had to put coins in a meter to get your electricity. So in a world like that, with 1/4 of UK households having to think before they consume, those thermostats are going down and consumption has been hit, most definitely. Whether it's the case in transportation fuels is less clear cut so far. I think there are bigger factors at play there, such as subsidies or removals of subsidies in large Asian consuming nations, and still structural substitution of expensive gas with not just coal, but also with oil.
Christoph, just to wrap up this segment on the sort of legacy of Fed and tightening cycles, we've seen the sort of major Western central banks being somewhat in alignment, but the US being ahead of the curve compared to the ECB and the UK, and so consequently the dollar went bionic. Are we now seeing the dollar that peak is also peaked? And now, I mean, the UK just, I don't know, it's sort of counterintuitive on so many levels. The sterling looks bionic now, and the economy looks like it's about to collapse. Can you just talk us through a little bit about where you think these disconnects are going vis-a-vis the currencies?
I mean, they have been driven clearly by expected interest rate differentials. So by markets taking Fed announcements very seriously, and by the Fed in their announcements, and also then in their actions going ahead, as you said, of the ECB or the Bank of England, not to mention the Bank of Japan. And as the others are catching up, these interest rate differentials one would expect to become smaller. And I would, in currency markets, at the end of the day, expect a fair degree of mean reversion, except for one potential sort of permanent influence, and that is if interest rate increases especially in Europe, but probably also in the UK, are less than what was required in the US, because the economy is less buoyant in these countries. And so inflation is easier to control with smaller interest rates, because the demand is not as strong in Europe and in the UK as it was in the US. Then you would see a lasting shift, presumably, between the dollar on the one side and the pound and the euro on the other side. But that will become apparent when the end of the cycle, of the tightening cycle, is sort of in the public discussion in Europe and in the UK, as it is now in the US. So that's, I think, is all there is to these interest and then currency differentials. So they will mean revert.
I think just to wrap up on that, I think one takeaway that keeps ringing in my ear after hearing the Fed chairman's press conference yesterday is they still very focused on that 2% number, and getting there seems to be a very determined. I mean, it's not only a choice; it is part of their remit. That's their job by the Congress.
And the reason is that they are, as a central bank, that they are worried of being big by these debt levels, because what is emerging on the horizon is a situation where the Treasury, or in other cards, the finance minister, says, okay, we have to refinance that debt, and can you give me a hand, dear central bank? And the central bank is trying now proactively to erect the walls which would fend off this kind of fiscal dominance, as it's called in monetary cycles, in economist cycles. The dominance of the need to get rid of the debt by a little bit of inflation,
Mike,
or including that.
Moving on to the second sort of big theme of the year, and we end the year with it very much prominent, is the China story. You've always been rather bullish on that and the outlook for China. Your thoughts on where the year ends up for China? It's obviously a reopening narrative at the moment. How big of a one, how quick, and so forth? Welcome your thoughts.
Yes, COVID headlines out of China have all been rather constructive of late. There are clear signs that public policy has shifted towards no longer zero tolerance and restrictive measures, and a realization that, probably guided by their chief medical scientists, that this particular variant of Omicron that is running through the population a lot faster, I think, if you just go by the small sample of my own colleagues in China. Many of them have it right now. They all know somebody in their family or in their close circle of friends that has it, and that's across 3 different cities. So it looks like China is in the process of becoming self-immunized, if you like, via a more liberal policy of allowing the virus to spread in a way that is reasonably contained. And there are many, many anecdotal pieces of evidence for this. I mean, it is no longer the case that you have to quarantine in a public facility, you self-quarantine. The amount of invasive testing procedures are no longer as prevalent as they used to be. There's a lot more freedom of movement. There's not yet been an edict from central government that the grand migration, which is for Chinese New Year, where you can get close to 500 million people getting on trains, into cars, onto public buses, and going to see their families at Chinese New Year, is going to be discouraged, as was the case for the last 2 cycles. And Chinese New Year falls early, so this is going to start around about January 7, 8. Air travel is up. Public transport has been made free of charge in certain cities. China Eastern came out with a headline today that they have 1,380 scheduled domestic flights. That compares to only 540 odd flights on the 1st of December. The populace in China seems less scared of the virus than was the case just a few weeks ago, and is self-immunizing in a way that might happen a lot faster than we think. So, of course, the measures are still there to avoid congestion of the scarce ICU capacity for the elderly, but there's been a massive vaccination drive, we believe. China's population is much more heavily vaccinated than was the case for any other major economy. And having protected the population from catching the virus, I think of all countries to see the main wave, which seems to be impending now, it's probably the best prepared of all countries. And as such, it stands a reasonable chance of not suffering the same toll that was the case in many other large countries. So with that degree of confidence in the economy, we have colleagues in China suggesting that international inbound air travel in China could be a reality as soon as Q2 next year, which was not in most people's balances and supply-demand predictions going forward. So that gives you a bit of a Nike swoosh or a J-shaped sort of view on demand for transportation fuel in China, and notably jet fuel, which is the big absent portion of the oil demand barrel, and has people getting quite bulled up for the second half of next year, if not somewhat sooner. But in the near term, of course, one still has to be cautious because the public has been conditioned to self-isolate, to distance themselves, and to avoid getting this virus if they can. So we also have to bear in mind it's not like Christmas in Europe in 2020, 2021, when you couldn't stop young people from partying and creating extra super spreader events. So fingers crossed, this particular variant looks like it's not going to be of too much concern. And yes, I stand by my relatively upbeat and bullish stance on China. I've always been at that end of the spectrum, and I stand by it.
Christoph, your thought, I mean, we had the World Health Organization come out yesterday, which I thought was interesting, making the statement that this spread was going to happen. It wasn't because China reopened, it was already well underway, and China, in a sense, had no choice but to get out in front of it or else be sort of somehow caught on the wrong side of the optics of all of that. But Christoph, your thoughts, China reopening, we're not necessarily seeing a great level of optimism in the oil markets as a result. And many would have thought on these kind of headlines, the front month would be soaring ahead. I mean, it's climbing, but there's no great rocket fuel, so to speak, in that. Your thoughts on China's current position as we end the year?
Well, there isn't in the oil markets much enthusiasm, and rightly so. I think since we have this joint podcast, Mike was on the bullish side and I was on the bearish China side, and I think the bearish side has been right so far. I think for a few additions to what Mike has said, the most important one is that there is a downward trend in Chinese economic growth for reasons which have nothing to do with COVID. For reasons of financial instability, of overexposure, for reasons of the shift from industry to services, for reasons of aging in the economy. So if we talk about trends, the reopening of COVID or not reopening of COVID, you will observe in a few years' time a sort of short blips around a trend where the growth rate continues to be low and to fall and to sort of hone in somewhere in the 3.5% range, if that, but not No way. It goes back to the 8 to 10% rates of decades past. So that's the big issue. The smaller issue is, I agree with the World Health Organization. They probably opened it because it was uncontrollable, but I don't think it was their doctors who told them about the point in time to do it. I think it was their security people who told them about that, because it created obviously sort of social tensions. And these kind of tensions in a highly managed, shall we say, administered economy like China, with this kind of political environment, they're gonna come up again and again and again. This is the other side of being very efficient and very effective in organizing the economy. When you suppress the political freedom, at some point it clashes. The more decentralized, the more service-oriented, the more financial sector-oriented the economy becomes, the more dependent, in other words, on individual decisions and brains, the sooner and the harder that clash. So that also will not go away. And then finally, I think transport demand, yes, may pick up, so people are burned, but I'm not so optimistic about the near term either. And the reason is that, as Mike said, vast majority of the people are vaccinated, but with what? I mean, their whole behavior indicates that they think that the Sinopharm is a placebo, the people in charge who know about it. And so estimates by also the World Health Organizations are for a few million dead people. And that may also create, all sorts of unforeseen short-term durations of a political sort, or of continuing lockdown somewhere, or all kinds of, hard to foresee short-term volatility coming from the disease side. So it's a good thing that they are opening up. And in the end of the day, I don't think anyone has any recipe against this pandemic except mass immunization, so everybody gets infected. But the short-term risks are considerable. And most importantly, it's a blip around a long-term trend, which is downwards.
Mike, your thoughts on that? I'm really interested on any, you want to feedback on anything Christoph said, but also just on that point on the legacy element. We saw in a lot of ways the COVID period was an accelerator in many parts of the world of change, and trends were brought forward, digitalization and other things. But what do you think is the sort of accelerator in China? We've seen a lot of big supply chain, and Apple relocating manufacturing facilities to India. Will we see an acceleration, do you think, in the manufacturing center of the world away from China? Your thoughts as a legacy, and anything you want to feedback on what Christoph said?
I think the world has been in relative isolation from one another. And of course, China was one of the more isolated major economies in the world. Whether we're going to see a lasting impact because this pandemic taught us that it's good to have your eggs in multiple baskets rather than have your entire manufacturing in one country, which could be China, I honestly don't know, Sean. But yes, I mean, there's been this new term that's come up in terms of nearshoring and distributed economic efficiencies. I think it is quite likely the world's going to snap back into normal again. I mean, there's even been a medical scientist in China that claimed that, this is not COVID anymore, it's just flu. That seems to be the slogan of the week. The market responded with people getting particularly upbeat about transportation fuels. Brent came from $75 earlier this week to $82 now. That's mostly this revelation in terms of a view that's changed from the 1 to 2 million deaths that some Western media or Western consultants were prognosticating about, which, I mean, China would never, if they felt that was the toll that was likely, they would never do what they're doing now. I really think there is a sense of belief that this particular variant, heaven help us if it mutates, of course, but that this particular variant is one that can be allowed to run through society, create that, what some people call herd immunity, which I said a few minutes ago is already the case in my own office over there. And hopefully this ends up with people getting back to normal as soon as possible, including international travel.
If you look at the last week, Mike, just in that upswing in oil price since we sort of tested 70 on WTI, definitely, but on Brent as well. And we had that accident with the Keystone Pipeline in the US. That seemed to be the big oxygen for the upward movement of price. Your thoughts on sort of splicing apart this LASIK sort of recovery from the sort of nearly 1 year lows we saw last week?
Yeah, I mean, I think last week was earlier this week was the first time we saw this year's price action go below last year's price action. I think most of the oil price recovery was down to the China news, not the Keystone news. Yes, I mean, in the US, these prices with WTI moving towards $70 a barrel, hits a level that coincidentally Joe Biden had said he would refill the SPR at. Now, that was before the midterms. He's retained the Senate, so maybe that's less necessary. But I think there was a consensus in the market that at some point oil becomes cheaper because, as was shown in one of the headlines you circulated in your top 10 News Digest, there's going to be a slowing of outlay in the Permian Basin and those price-sensitive exploration plays which are responsive to price. And with the escalating cost of producing from those regions, I mean, I think the days are gone when your marginal cost there is $35 a barrel. It's definitely higher. People slow down. They deploy fewer rigs. They don't do what they've been doing for the last few years, which has been pushing costs steadily higher.
Let's get the survey question in before tackling the final of our topics, which is sitting there at number 3. Which 2022 trend will dominate sentiment of oil markets on January 1st? China COVID reopen, Fed tightening, inflation, or 3, the Ukraine-Russia sanctions? Which will dominate the sentiment of oil markets, the direction of oil markets? Christoph, we end the year, of course, with the Ukraine warring somewhat continuing to recede from the front pages, headlines all the time. But obviously, we had the price cap and the EU embargo come into play just last week. Your thoughts on where that story ends the year, how significant it is? It seemed that both the embargo and the price cap sort of were landed dead on arrival.
Not necessarily. I don't know if you refer to the gas or the oil price cap, but
oil.
Let me say something about. There's 2 major topics. I think one has already been mentioned earlier, which is the gas prices and the situation of natural gas in Europe, and will Europe sort of hold the front, so to speak. Mike mentioned it, that high gas prices sort of had this demand impact, and the demand decline was actually quite dramatic in countries like Germany as a response to these high prices. And, to quote again this small village in the Black Forest, which has been mentioned here several times, where we have a house. I got a call, just to give you an illustration, the other day from a neighbor who said there's a disconnection notice on your front door. And, this is a leaky house heated by natural gas. So I said, well, how can this be? Because there was an automatic bank withdrawal thing to pay the bills. So I called up the bank, and it turns out that the sudden jump in the bill was so much that they thought there's a mistake and they stopped the payment. So that's it was really, I mean, it was really awful. We're talking by 2 digits of magnitude up.
That could have been a very, very expensive intervention.
Yeah, and so nevertheless, so that's what everybody experiences, except I'm sitting in Abu Dhabi and they sit there and freeze. And still, you have opinion polls being very clear that there is a minority which is growing, which is upset with that situation, but a rock solid majority, over 70% in the Central European countries, supports these measures against Russian gas imports because they despise this war. And I think that's not likely to change. So that will hold through the winter. And next winter, some people raised the alarm already, but I always say a train which you see coming is not a big danger anymore, actually. On the oil price cap, this is very interesting. This touches sort of the second area, which I think is important when we think of the Ukraine war, which is this not just military war, but the economic warfare, the way sanctions work. I was surprised when you and Mike discussed oil price increases, there was no reference to the price cap, because what happened when the price cap was introduced, prices, to my surprise, at least fell immediately in reaction. When you think a little bit, it's clear why this happened, because markets certainly got some sort of guidelines. They knew what to buy, what not to buy, and immediately the discount shrank, because the discount for Russian oil is just an expression of the uncertainty which was in the markets. In this case, the discount narrowed by the global price for Brent and WTI coming down. I don't think this is a lasting sort of relief. I think the price cap idea in oil is a very bad idea. I think it introduces, multiple prices for the same commodity. We have now a global price for Brent and WTI and other fuels which have nothing to do with Russia. We have a discounted price for Russian crude, and we have a market cap price which happens to be above the discounted price for some of the crude. It gives Russia a trigger in hand where they can threaten and then not just say, as it's always portrayed, yes or no, we cut oil supplies or not, but actually scale them up and down, vary the lengths, they scale them up and down, and hence have a profound impact if they want to on the global economy. And why would they not? If they're cornered, they would do the same as they did with gas, of course. And finally, the price cap, if it works, says goodbye to this idea of driving down Russian export volumes and thereby seeking to damage long-term Russian production capacity. So all of this goes out of the window. Therefore, I don't think it's a good idea, and we will hear more of that. But it's going to create more havoc in markets. Right now, it's sort of a quiet period where everybody sees how this develops and where Russia has not acted yet. But that we should not rule out, especially if the military side of the conflict goes wrong from Russia's perspective.
Well, they did say that they would consider cutting production. Mike, your thoughts on the absorbing of these, where we're at the end of the year here, the war, but the sanctions, the embargo, the price cap?
Yeah, we can't have one of these calls without one of us disagreeing with one another. So I'll just pick on Christoph's comments about the West wanting to damage Russian production capacity. I'm not sure that's the case. They want to damage Russian revenue or limit Russian revenue streams to fuel the war effort, I guess. But I don't think anybody really wants to see Russian oil production capacity shut in or damaged, because it's just too much for the world to do without. And the Russians know that, of course, which is why they can boldly defy the cap and say we're not going to observe it. And of course, there are some.
But how do you maintain Russian production capacity, not in the short term, but over the medium term, if all of the world's best practices and best technologies are removed from the field?
You cannot.
That's a fair point, and it goes for other segments also where Russia depends on technology from overseas. So that's a fair point, Sean, for sure. But I mean, the price cap has only been set at $60 for what seems to be crude oil, and we still await what the price will be for code 2710 higher value products such as diesel. So if the price cap is seen to be applying to all oil, including diesel, one wonders how diesel will flow out of Russia. There will be counterparts, because markets work this way, and the history of sanctions and trading sanctions has shown this many times over. There will always be people who find ways of not observing them because they find the mechanisms not to. In my view, the biggest constraint is not just the financial system, but actually the requirement for insurance. The way these P&I clubs work is they put in place about $1 billion worth of insurance to cover any potential, heaven forbid, accident and spill, environmental catastrophe, and that money is syndicated out through a bunch of underwriters. We used to call them names at Lloyd's in London, who largely sit in Europe and in North America. And whilst there is talk of underwriting institutions, P&I clubs from other parts of Asia, and Russian P&I clubs themselves, which apparently tick the box for Erdogan to alleviate the queue in the Bosphorus, it is hard to envisage how one would go about recovering a claim for an accident caused by a ship that has a Russian P&I insurance, because the banking system will kind of choke on that to start with. So the prospect of uninsured or underinsured cargo and hull and machinery plying the oceans in generic terms heading from west to east is a major concern. Then, of course, the banking system needs to find a way of transacting without an EU or Euro or US dollar nexus as well, which is very, very difficult. And of course, the intention of the price cap was to allow trade to continue to happen with Western P&I insurance, with the Western banking system continuing to finance these trades. But for as long as Russia says, no, we're not going to observe it, we'll not sell on that sort of basis, and the basis has to be fixed price. And to the extent that there are certain Asian consumers that will continue to buy Russian oil and find ways of not having to fall foul of the G7, Japan, Canada, Australia set of rules underpinning the price cap. Russia will find ways of continuing to move that oil into Asian markets, as is already the case. The question is how much will Asia be able to take? How much will the shipping industry be able to take before that is saturated? And it was quite interesting to see OPEC, I can't remember who it was now, but one of OPEC nations came out with a view that Russian exports may be down 850,000 barrels per day year on year, which is give or take 8%, right? Which may be fed into their thinking when they rolled over their production quota, which was not seen by the market as a positive, given the China prospect of COVID demand damage was already in view, and OPEC didn't take oil off the market as some had expected them to. So yeah, it's
well, we end our conversation and our year with the word OPEC, which we didn't mention all through the session. I didn't put in the top three, as it sort of is still obviously a big factor on the supply constraining side, but I felt in some ways that the story ends the year with more of a demand piece. But yeah, OPEC plus still a big factor in this market. The survey group, China, and Fed still sort of competing. Ukraine, Russian sanctions less a factor going into the new year. Of course, into the new year, we have our launch of the new year, our forum on January the 11th. This survey actually is a price survey we did about mid-year of where the price of crude oil would end on the last day of the year. And closer to 90, closer to 100, closer to 80 was on the lower end, not seen as much. And perhaps it's now a bit more likely, but we could still have a big sort of push upward over the coming weeks, perhaps when Mike goes on his holidays and all the rogue traders are at their desks and we're trading on thin volumes. We can see usually bigger moves. But thank you so much, Mike and Christoph, for the whole year. Obviously, you guys are the brain of the engine, and really appreciate that. And hopefully we'll see you both on January 11th for the Round the World Year Ahead Outlook, where we will have 50 commentators in one day, starting early doors in China and go right around the world over 12 hours, ending in Mexico, for what will be hopefully a very useful marathon of insights and forecasts for the year ahead. But until then, have happy holidays, festive season. Cheers, a bit of downtime for everybody. Oh yeah, and also rah, you know, I have to be Santa Claus, even though my youngest kid is now nearly 14. I'm still going to insist he sits on my knee and I go, ho, ho, ho. All the best, everybody. Cheers.
All right.
Thank you.
Bye-bye.
Thanks, Mike. Thanks, Christoph.